Welcome back. Good Thursday morning, everybody. Investors, economists hoping for more participation in the workforce in tomorrow's jobs report. Our aging population, partly to blame for the shrinking labor force and slowing economic growth. A study cited in the Wall Street Journal finds that GDP growth falls by 5.5% for every 10% increase in a state's population of senior citizens. This is because the labor force grows more slowly as more workers retire. Joining us to break it all down right now is Stephen Auth. He is Chief Investment Officer of Federated Investors. Stephen, good to see you.
Good to see you, Maria.
When you look at the labor market ahead of the numbers tomorrow, how do you characterize it, and how does that show an overall economic growth story?
It's solid. We expect 180 tomorrow, which I think is right on consensus. We're right there. I think we're probably, as long as we're somewhere under 200, it's sort of back to this not too hot, not too cold kind of labor number. Keeps the Fed on the sidelines.
Keeps the Fed on the sidelines, but it's this sort of slow crawl in terms of growth, Mike. I mean, no breakout.
No breakout at all. And I think the worst thing for the market would be another number like we had last month, where it showed a lot of growth, because then I think you'd hear more talk about the Fed raising rates.
Right.
I think the biggest, we can handle slow growth the way we've been. I think the issue is what happens if growth picks up and the Fed has to move and start raising rates. I don't know how the market reacts to that. In the past, we've seen a sell-off.
Would that be this year?
Sooner or later, they're going to have to hike. We think December, Maria, but there's no way they're going to hike before the election. I just don't see it.
No way, huh?
And particularly with the world situation so uncertain. So as long as they're only hiking a little bit, one at a time, it's a kind of stable situation. The thing that would really spook the market is if growth accelerates and inflation numbers start to finally pick up, wage gains start to get outside the range they're looking for. And that'll be something people will watch tomorrow, actually, probably more than the jobs number.
Does it bother you that now the presidential candidate's talking about, in terms of the aging population, fixing entitlements? Medicare will be insolvent in 12 years, according to the latest trustees report. For Social Security, it's not much better, 2034. And there's no way, given the, $90 trillion liability, unfunded liability for entitlements, that we can grow our way out of it.
One of the things that makes me a little bit nervous is a lot of the Wall Street strategists I talk to, I come to the office, and everyone's talking about a big fiscal spend next year, one way or the other. I think the market's starting to price in a kind of fiscal stimulus-driven growth recovery.
On infrastructure.
Right. And if you look at the numbers, the reality is, even though the deficit's come down the last few years, starting in 18, the sequester rolls off, and the entitlement thing really starts to expand because of the baby boom retirement. So whoever becomes president is going to be facing a fiscal situation that's not nearly as good as it is today. And I think we might get something like a a Japan-like kind of thing, where the headline looks great, but the details are not so great.
No conversation about that.
I don't think they have a ton of room.
I think that people should be talking more about these kinds of things. It's just distraction. Everyone agrees it's a problem, but everyone says, and then they move on to something else.
They don't even agree it's a problem. Hillary Clinton has promised to expand Social Security.
Right.
She wants to expand Medicare, and Donald Trump says you can't touch Social Security.
Don't touch it,
I think that those
they're all thinking they're okay right now. But these numbers are going to start to expand. I think it's going to put the next president in a bind.
I mean, what is it? Is it denial? Is it because they can't think of a solution? They hope people don't notice? Because if you look at it,
it doesn't resonate with the public.
Okay.
It doesn't resonate with the public. People don't understand it, and they leave it.
No one wants to hear you're going to cut my Social Security.
We're not talking about another scenario that could happen, and that is recession. I mean, there are still people out there who think that the U.S. will go into recession. You look at the outside forces. The Bank of England expected to announce a decision in just a few minutes. We'll get that decision, and then we'll bring it to you. But they're expecting, the investors out there, that they're going to cut interest rates for the first time since 2009. Does that affect markets at all?
Well, UK's in a recession, Maria, on our numbers. So I think they're going to cut. The question is it 25 or 50? I think the market will be disappointed if it's only 25.
What about a recession here, though?
We're going slow growth. We don't see a systemic risk. So we could see a pullback to zero, maybe. Who knows? In our recession scenario, if we get one, it'll be a modest negative as opposed to a banking system collapse, a sort of 08, 09 kind of scenario. But it's a risk out there. I think right now it's not the highest risk. We're just kind of steadily going along. And if it is one, it's not going to one that's going to take earnings from 120 to 80.
Right. And we've seen this slow growth area where we're talking about 1.5% growth.
Right.
So if we miss and we come in with 2
plus or
quarters of
minus,
negative, it's very small impact.
It's more of a risk of a scud from outside,
Agreed.
and we think a scud, maybe Europe could be that scud.
Would you put money into Europe right now?
I'm a little cautious on Europe.
And in terms of allocating money to the U.S.?
We're overweight the U.S.
You
It's
are.
the only place to be, but we're underweight equities relative to bonds right now, modestly. We're recommending about a 50% equity weight, so it's a little bit under our neutral point. So we're a little cautious here. Valuations are pretty good, but we think in this 5-1s world we've been talking about, $1, €1, £1, 1% on the Fed, the stocks can keep sort of crawling along.
Stephen, great to see you.
Good to see you,
Thank you
Maria.
so much for joining us. Stephen Auth, Federated this morning.